We spoke to lenders based out of the US, based out of Europe, who really got the idea of a fintech and how to underwrite it. But you say, hey, let's do a deal in the Philippines, let's do a deal in Mexico or Kenya. I think that's too far for us.
Hey, why someone from the opposite side of the world understanding a market, your market better than you, and you grow enough of a reputation to then start educating a market as well.
When we think about what often kills deals at the early stage, it's bad data, which as a fintech is highly disappointing, but it's very common, is your data set around your portfolio is not clean and we can't understand it, we can't integrate it, we can't then analyze it.
In our case, our client is a client that would never be able to go through the doors of a bank. Not because they're unbankable, in fact, a lot of them have a bank account, but they're not understood.
Okay.
I'm Gregorio, I'm Italian, founder of LISI, based in South America since 10 years. LISI is an asset-backed lending company that specializes in financing people who are on the margin of banking. So we capitalize on the digitalization of an economy, specifically the gig economy, and created a product around that. We operate in Peru and Mexico and now spreading throughout South America.
Great. I'm Suresh Samuel. I'm the managing director and head of Fintech investments Lendable, and to be clear for everyone in this room particularly, we are not the Lendable, which is the consumer lender here in the UK. We are a provider of debt financing to fintechs, traditionally in emerging markets, so our portfolios across Latin America, Africa, and Asia. We actually just concluded our first transaction in Europe with the deal in Germany, which we'll announce soon. We're providing debt financing generally supported by assets of companies like LISI. And so part of the session today here is really talking about the journey of LISI, how we have come to it from a lending perspective, and how we work with effectively startups as they scale up and think about their debt requirements. I think a lot of the discussion today has been around equity, so turning it a little bit to how debt plays a role in the expansion of these companies.
I think a question we get very often is why raise debt? No, I think the gold standard for any sort of valuation of success is how much equity you raise, who you raise from, and specifically in Latin America, Tomas was mentioning before, there's not much investor ecosystem, and so for us specifically, we understood quite early on that the importance of debt would help us essentially have a longer stretch of the money than you would if you were to do or fund a business full equity. No? So this changes a lot the way you approach a business. You can't just switch from the night to the day an equity funded business versus a debt funded business. But it is something which I think over the long term gives you a much deeper understanding of how far you can go, what resources you can use. People I think forget that banks have always been the original kind of backer of businesses. And for us, finding Lendable very early on, because I think our first facility was 15 million with you, really allowed us to not only get a validation of approval, obviously debt has a different risk profile than equity, but then also allowed us to have better resources and more efficient use of capital to get to where we are today.
Yeah, and I think for fintechs where capital is a main part of their product, so whether you're lending, whether you're a payments platform moving money and you need capital in different places at the same time, we think debt is more efficient at scale than just using equity. I want to be very clear around the use of debt because I think there's different debt types that can play a role here. From a lendable perspective, we're providing debt to finance a product on an accretive basis. So we need to be improving your ability to grow to generate net or unit economic positive revenues to your business. There is a kind of another scope here that works with fintechs, which is our pure venture debt lender, which is often around runway expansion, financing costs that may not be accretive to the business. That's not what we do. That's a different place. We're wanting to support portfolio growth, payment flow growth across our markets through these companies. And I think this usage of debt is really important, particularly for companies as they think about, debt does add risk to your business, right? Now is a requirement to pay down and service that debt. It is going to be more strict than equity on what you have to do to comply with the terms of that covenant, but it's not diluted to your business typically. Of course, there can be mechanisms where it is. And if you're trying to build, for instance, a loan book or an asset book growth, it's going to be much more efficient to do so with some debt as part of your capital stack.
I think there's not all debt is the same either, no. So in our case, the debt goes to fill an asset. So asset-backed lending is a bit different than perhaps getting debt to acquire customers or have a less visible outcome of where you invest that money. I think one of the things that when we're speaking with Endeavor team on how to structure this panel, one of the big questions that they wanted us to cover was the importance of being in the markets that are not known. No, for us specifically, starting from Peru, a market that really has almost no ecosystem of investment, that when it came to finding investors that were willing to understand the market was also a similar challenge. But when we met you guys have a very wide scope and almost a geographically agnostic scope. Maybe I think it would be interesting if you could explain why it's so far.
Ours is very much, the reason behind that is very much with intentionality. So Lendable was founded a little over 10 years ago, originally with a focus on East Africa, so founded in Nairobi, and with the intent to support businesses who expanded financial access to underserved customers. And we thought that was really done effectively through fintech and bringing that fintech to scale. And one of the reasons we started in Nairobi is back 10 years ago, it was on the leading edge of fintech globally. So digital payments were well entrenched by this point in 2015, ahead of developed markets, ahead of here in the UK, ahead of in the US, in terms of people sending money back and forth to each other digitally, paying for transactions digitally. It was all done, so cash was quickly going out of the system. And it effectively leapfrogged this requirement for credit cards or other means, or writing checks, to be honest, either cash or digital payments. And so on the back of that, the fintech ecosystems really, really grew from an early stage and service customers because they were able to get data points that were not traditionally available. And so that was the original thesis within Lendable about why did we start there. But we also found a ton of businesses, a ton of customers that were really unserved from a debt financing perspective. An example is prior to joining Lendable, I ran capital markets for a fintech company called Tala, which is based out of the US but works in a number of emerging markets. I was going to raise the initial institutional debt capital. We had raised a lot of equity from kind of top tier venture investors. I needed to build a debt program for the company. And we were talking to either investors who knew the markets locally, but they traditionally financed much more established institutions and did not know what to do with a fast-growing fintech with a heavy data set that needed capital that was flexible and could grow with them. Or we spoke to lenders based out of the US, based out of Europe, who really got the idea of a fintech and how to underwrite it, but you say, hey, let's do a deal in the Philippines, let's do a deal in Mexico or Kenya. That's too far for us, right? And so the thesis behind Lendable to me was very clear. So when I got the opportunity, I jumped over to Lendable. And that continued as we expanded originally from Africa, and then we went to Southeast Asia, and then we went to Latin America. Look, these are places where there's really generally amazing opportunities from a commercial perspective. There's fintechs doing great work, and our ability to service them with capital is, I think, a great way for us to, of course, expand our own business, but to support these businesses, not just as they start in Peru, but as they expand to Mexico, as they expand to further markets. That's always been a thesis of what we do is, look, we'll get in, we'll do the dirty work of learning the markets, learning how we can structure transactions in there, learning how to mitigate the risk, the macro risk, the currency risk, things like that are very important to us, and then go focus on supporting good businesses. And I think that's really given us a lot of opportunities as we've grown to service this market on a truly kind of global scale, particularly from an emerging market perspective. Also, the other interesting point here from being in an Endeavor event I was looking at before this session, we have about a dozen Endeavor entrepreneurs in our portfolio, a very recent portfolio. And I think that's because there's a lot of overlap in our mandates. And why is that? Because there's also a lot of opportunity. There's a lot of work to be done that is not being well serviced by the mass market of capital at this point, right? And so I think for us, it's part impact thesis of what we want to do from a mission perspective, but certainly as well from a commercial basis, and that's what supports our investor thesis as well.
And funny enough, it puts pressure on the local lenders, no? Again, there's very few banks in Latin America, and what you start noticing is a market that they would know and you'd imagine they would be the first ones to want to fund. They kind of thrive on closing the door on it. So with us, specifically with Lendable, we're able to put pressure on local banks to show them, hey, why is someone from the opposite side of the world understanding a market, your market better than you, and you grow enough of a reputation to then start educating a market as well. No? So in a way, because of this kind of global view you have, you end up having an innovation that otherwise, if you were depending on the financing institutions that you would expect to be innovating, you wouldn't really get anywhere. No? For us, a big part of it, and you mentioned it before, was also how the landscape changes quickly. And specifically when it comes to underwriting debt, a big part of it is a risk, and a big part of understanding the risk is understanding the customer. And in our case specifically with LISI, what we end up doing is we use alternative data to underwrite what would be otherwise a credit which, according to a traditional financing institution, would be ununderwritable. No? And this is where there's a match, understanding that you trust and obviously validate the way that we see this risk, understand this kind of risk association with the cost and the product and how we build it around this new customer, and make sure that the product that we have is perhaps not in a little square box as tidy as you would want it, but the outcome is exactly the same, if not actually better. No? I think you guys must have a bunch of these success stories. I think it might be interesting to understand kind of maybe what you look for when you're underwriting, and understand how you gauge the risk other than the outside metric.
Yeah, for us, I think this data component's really important. So to this point, we are trying to structure transactions that are specific to that business and really make it fit for purpose. But we're going to diligence that very hard because the risks are clearly there. And so one of the things that's really important for us is really understanding the product. And by understanding the product, it's not just you tell us about the product. It's actually we get into the data, and we're really doing a lot of data analysis and data verification independently with third parties. So understanding how the bank statements who are third party sourced are actually showing that your performance is what it is at the individual loan level, right? And that's really important for us to make sure that we can then say, hey, look, the unit economics after the cost of our financing are still healthy. You can still grow. We can still understand that your business has kind of scale to it, and we don't want to take equity risks, so we need to make sure that we are going to get repaid. And so one is, I think, for working with earlier stage companies, and LISI is a unique story. We didn't really talk about the history where LISI came to us kind of seed stage for debt, which is even early for our side. But I think it was Thomas from Global 66 was talking about the requirement to start from a profitable business. They were already a profitable business. So in some way, you're de-risking this in that they were building out a use case in a very responsible, structured manner, which gives us a lot more comfort in terms of the risk exposure we're going to take. But that's not always the case. And so what we are looking at is, of course, that data component, the operational excellence, even at that early stage of, is your financial reporting good? You guys actually know what you're doing in terms of servicing your customers. We're thinking a lot about the economy. So we work in a lot of places. We're in 15 countries across emerging markets right now. There's a lot of countries we still can't work in, right? So we need to be able to get money in and out of the country. We need to understand what the regulatory environment is in that country. We need to be able to take collateral in a way that's meaningful to us as a lender in that country, and that does not apply to a lot of places, unfortunately. And so that's something where we'd love to see more from a regulatory perspective, improvements there. But these are all things we're focusing in on. And then we are also very much building a relationship with the business. As much as we want to be quantitatively and structurally focused, we do realize our best outcomes are where we can be partners with the business. We can work through tough times with the leaders of that business. Where we've seen troubles is actually where there's been friction points there. And so we also really want to build businesses which are transactional to the initial deal we're trying to do, but thinking beyond that. How do we grow with you? But how is it going to be as a counterparty to you? Because we are going to be in this together, right? We don't want to trip up your company as you grow if you breach a covenant, but we also need to make sure we're being respected as a lender, and we're gonna get our capital back. And so it's this combination of diligence, relationship building, structuring, all of that we're going to be focused on.
Weirdly, more than equity, I feel like as a debt partner, you have to have the company that you end up investing in succeed. There's no room for error, in equity, sometimes there's all these stories you hear in VC that you could be a hot topic, you're not anymore, they shelf you, they end up, a bad equity investor can be very damaging to the company. I think, obviously, if you have bad unit economics or a bad approach to debt, it can be much more damaging. But at the end of the day, when you do find that alignment, it is both wanting you to succeed. And as you both succeed, you have this multiplying effect. We always get asked how you negotiate this, and at the end of the day, there's this thesis that your investor wants the opposite you want. They want the most of your company for the least amount of price, But when it comes to that shift changes, because you understand that the importance of the terms dictate the survival rate of the business. So you're much closer to where you would go, and the conversation is not so much what you want or what I want, but is what makes sense, How can I make you as a lender feel comfortable? What visibility can I give you? How can I structure the product or mitigate the risk that would be associated, compared to maybe in an equity conversation where the conversation is just about what multiples you're going to go to, and what market you're going to get, and how much money you're going to invest to go for it. For us, I think this is something we find ourselves talking a lot. I think we were the first transaction for Lendable in Peru. I know that
in Peru, that's correct.
In Latin America, you did more, and I think now you're looking at more. If you've done more in Peru, and we always get asked like, what do you negotiate? How do you negotiate it? And at the end of the day, it's just understanding risk in a way that is on parallel terms to the counterpart. And I think with debt, it's one of those unique examples in which you're naturally more aligned than you would with any other kind of investor and investee relationship.
Yeah. I guess to turn that back as well, how do you think about lender selection?
There's multiple things you have to think when it comes to lender. A bad lender in a way can destroy your business. So I think the first one, you have to understand someone and see the track record of them having invested in businesses that they help multiply. You wouldn't have been happy if we would have just stayed at a $15 million facility. We wouldn't have been happy either. Understanding how far a lender can accompany you, what kind of hurdles it would put along the way. There's nothing worse than building a machine that's capable of selling a lot and then losing fuel to fuel that growth. So for us, it was a combination of understanding the lender, the experience they have in the market, the type of approach they have with different companies, albeit in different sectors or different geographies, but it's very much, I think, the DNA of a lender, how they approach that. The depth of the facility that they can go to, and the willingness they have to grow and see you go into those larger scale facilities. And then the third one for us, obviously I think for many, is also the cost. So understanding that the cost is something which balances. We were at a stage in which we had a few debt notes with local banks. The first bank we had gave us $500,000 and said, okay, let's wait 18 months. And we were just growing a huge waiting list of clients. And even though it was a much lower cost than what we got with Lendable, we kind of balanced it on the other side with being able to scale at our own rhythm. So part of it is also deciding, depending on the stage in which you're at, what you favor more, growing more aggressively or growing at a lower cost. In the debt world, you can always end up refinancing your debt. You can always end up finding a lender which, once you have a certain critical mass, can come and lower the cost. And this is something which you guys also were very understanding of from the beginning. You're not going to be my only debt partner in the way perhaps an equity investor is your only equity investor. It's a shoe that kind of molds itself with the business.
Yeah, no, that's absolutely right. I think we probably have a different view than some lenders who want to capture the whole pie always, where we want to be supportive of the business. Obviously, we want to grow our relationship, and it's on us, to be honest, to prove continued value to our companies as they scale and they improve and they widen the prospective set of lenders. But we also think it's actually very healthy for a business to have a diverse lender base as well, to either service different needs, but also whether bumps in the road of whether one lender can grow further or not. And so I think that's something we're also very, very conscious of in terms of helping. Again, it goes back to the relationship standpoint, not strictly transactional of, what's going to be something that supports the growth of that business, which ultimately is very beneficial for the credit profile of the business paying us back as well, right? And so I think that's kind of a critical point for us.
And I think we get asked also quite often, in our case, part of this is understanding not only the tools that you use to grow in the region, but the region itself. No, with LISI, we're very typical in the journey we did. We did Mexico after Peru, but we're now starting to focus more on what would be considered non-sexy VC countries. No, which, if you depend on equity-fueled businesses, can affect your storyline. No, why would you enter Central America before entering Brazil? But when it comes to debt lending, you have much more of that freedom, and you can chase a market for what it's worth. It's risk versus perhaps just the fact that you want to go on a market because it's larger and it has better macroeconomic tendencies. No, I think it would be interesting to explain for founders that are outside of the kind of trodden path. How do you change the perception of risk, or how do you change the way your company accompanies through markets that are not the most traditional one?
Yeah, from a lender perspective and from a Lendable perspective specifically, I really do think it just comes down to the fundamentals. So is your data actually well captured? Is it clean? Can you actually prove out the use case of your product? Have you thought through the risks of, if you're sitting in Uganda and you have a business you want to get financing, but your prospective lender is a US dollar lender, how are you going to mitigate the currency risk? Is your financials well put together? When we think about what often kills deals at the early stage, it's bad data, which as a fintech is highly disappointing, but it's very common, is your data set around your portfolio is not clean and we can't understand it, we can't integrate it, we can't then analyze it. Your financials are not clean. Like, these things are going to trip us up. You don't have a strong regulatory understanding of your own business, those things will trip us up. So I think very much being operationally strong in running your business and understanding the credit profile. There is this balance because equity investors want something slightly different than what we do. And so we often see companies, when they're pursuing the equity story, you're trying to grow, but not necessarily building the foundational excellence that we as a lender will require. And so we're looking for companies that can actually balance that and execute on both, because that is quite important to us. And that probably, again, as I said, screens out a large number of prospective companies. Is, look, you can't even get past the first phase of giving us information at a standard that we can then go and understand.
A big part, I think, also where I found a match was the impact side. Yeah. No, again, usually when you think of business, you think of the return on money, but something which we liked as well, and I think opens a very specific path, both in our business kind of world, where you go to asset-backed lending, but specifically also with you in lending to certain segments of the population, which are also weirdly the ones that no one wants to lend to. No, in our case, our client is a client that would never be able to go through the doors of a bank, not because they're unbankable. In fact, a lot of them have a bank account, but they're not understood in what they do, where they work, what industry they do, the profile they have. Perhaps they had some debt in the past that wasn't paid. But you can start outweighing this when you start looking at the impact and the importance of that credit that goes into the final kind of product. No, our approach obviously is going for people that today are forced to be stuck in a poverty trap because of the lack of tools of debt, and I think that's where we had that first overlap, in which we were able to not only create a product for a market that desperately needed it to be able to kind of fuel the future middle class, but also did it in a way that was more than returning an investment, creating an impact that was macroeconomic, that helped not only a local economy, but also a much more broad spectrum of clients. How do you treat impact? Not all impact is the same. No, we have the longest reports that we do for impact, and there's so many different parts. What is perhaps for those here that don't know, the impact that a lender, which is impact focused, focuses on?
We love the business model of LISI and this idea that you're serving clients that others aren't willing to reach, or if they're being reached, it's with pretty poor terms, pretty poor options. And so being able to improve that financial access is core to what we do. And we love it because we have a deep belief that there is an underserved population, whether that's individuals or small businesses, who are actually creditworthy in their day-to-day lives. They're maybe borrowing from friends and family, often things like that. But because it's not captured in a systematic way, banks won't underwrite them, or there's not enough profit, to be honest, in the traditional from the traditional financial institutions for them to worry about that customer. And so that, again, goes back to the core thesis of why we're doing this, is really trying to expand that financial access, which, by the way, I think is a fantastic business opportunity for companies to go and serve, to figure out a way to do it on from a healthy business perspective, a profitable way that can be sustainable over the long term. And so for us, that is something we're looking at through our whole process is, not just what is the financial metrics we're looking at, but very much from an impact perspective, who are they serving? How are they serving? What is that bringing that others aren't in that local environment? And that's something we look at from day one, from that earliest conversation. It's formalized through our approval processes, and then we monitor it throughout the life of an investment.
Awesome. That hits you as you
Yeah, I
finish.
think
So
that's
I
it.
think you couldn't have planned it better. Thank you guys so much. It was really fun to talk about it. We kind of self-improvise in moderation, but I think it worked. In case you had any other questions or doubts, please feel free to bother us outside of